Hi, it's Jeff Waite here at stockideas.org, and today I just want to talk a little bit about active compounding and compounding your investments. So I've just pulled up a chart of the SPY here, which is the actively traded ETF of the S&P 500. And the point I want to make with this chart is that over the last year, stocks have generally gone up. And that's kind of what markets tend to do over the history of 20, 30, 50 years. They tend to go up. But the key distinction is, as you can obviously see, they don't go up in a straight line. So I think that's pretty obvious, is that they just kind of trend up, but they don't, whereas the moving average is a smooth line up, this is not. The stock is not. So that's an opportunity to kind of actively compound your investments. So, if you're a longer term investor in stocks, you can still use some swing trading techniques to take advantage of these compounding opportunities. So, if we look at a particular stock, on an even shorter time frame, this is Brooks Automation, which is a stock I've been looking at. And I actually own some. I bought it down here, and then I sold it up here, and then I bought it here, and then I sold it here, and then I bought it here. So, my point is that, this is a stock that fundamentally I think over the next, 3 to 5 years will do quite well and is positioned quite well. But I know in the meantime, there is going to be that chop. There is going to be that volatility. So to actively compound, I basically buy, anywhere from 1/8 to 1/4 positions at a time. So, if I were going to put, let's just say $10,000 into Brooks, I would, buy $2,500 at a time, and I would start, I would throw up some Bollinger Bands or some basic technical analysis here, or I would look for, some support levels, and when it got there and I fundamentally believed in the stock, I would, buy maybe a quarter position, and then, if it was showing well, I might add to it, and then, if the stock made a sharp move up, I would, sell a quarter position, and then when it came back 3%, after it had gone up 5%, I would, reinvest that quarter position, and then as it trended down, here back to the 20-day moving average, I would maybe buy another quarter position, and then buy another quarter position, and then I would be at a full position. But I'm comfortable with this cost basis as a long-term investor. But then it shoots up an immediate dollar. Okay, well, I'll take her in. So I'm saying you can basically, there are short-term trading opportunities even in stocks that you like long-term, and you can sort of manage your risk in the short term. For a stock like this, I might always have a quarter or 3/8 position size all the time, but I'll give myself some room to, manage the position a little bit and trade around sort of a core holding. And again, if you look at any ETF, you can basically do the same thing. If you're just bullish on American stocks in general over the next year and you believe they're going to continue to trend up, you could buy, even today after a big move up, you could buy a quarter position, and then when it comes down 3 or 4%, buy another quarter position, and then when that goes up, when you're 3 or 4% in the positive, then trim an eighth or a quarter position. So it's you're not always going to get it right. Sometimes you'll sell some here, and then you'll have to buy back up here, and then it will go down, and you'll buy again. But on the whole, with the volatility in the market, look at this, and this isn't the only stock. Obviously, and as you do more of it, you'll get better at it, and you can find the technical trading idea, or system that works for you. But in any stock, there's going to be volatility, and although you maintain a long-term investment in the stock, by managing the size of that position, you can get some income out of these areas of consolidation and chop, whereas, otherwise you would just have your stock sitting here for 5 months and you get nothing out of it. And as the consolidation goes on and price improves, you're probably going to have, bigger and bigger. You're going to sell less and less as it, because you think it's going to break out. And it's not a perfect art, obviously, but there is a lot of opportunity for kind of active compounding in the markets. So the other thing I want to say is you can download this Intelligent Swing Trader free mini ebook that I wrote. It's only like 10 pages, so it's super quick read, and it's free. So you can check that out, and it kind of talks more about this system of how you do this. And then alternatively, this book, The Best Trading System, by Chris Beanie, she talks a lot about this idea. It's her main point. The book is hard to find now, though, so you can read this review and learn more about it, but and you can try to maybe find a PDF or something online. It's out of print, I think, right now. So, but it's a powerful idea. You make compounding work for you over time, even if it's only 0.5% a week. That really pads your returns. And there's always an opportunity to do it. And if you have a 10 stock portfolio, it takes a bit of time, but it's definitely something to consider as a tactic to improve your investing. So if you want to learn more, just come on over to stockideas.org, and on any page you can download this free mini ebook where I talk a little bit more about this. Thanks very much for watching.